Welcome to Founders Unplugged, hosted by Greg McCallum. Long-form, honest conversations with founders and entrepreneurs from around the world. This is part 2 of this episode. Be sure to check out part 1 if you haven't already. Link in the description.
Both parts are an hour long. I completely lost track of time and thought we'd done an hour. We'd actually done an hour and a half. So this one's going to be only half an hour. So for those listening and watching, you might be relieved to know that there's an episode that is actually half an hour for a change. But yeah, in the last part, please go and check that out. I highly recommend it. It's great and serves as a great introduction to my guests and to the VC firm that they represent. But yeah, as I was saying to you towards the end there, and just before we click record, I'm really interested to know the future of the firm and kind of what you guys have planned. You mentioned that you're still relatively young, I suppose, in the grand scheme of venture capital, right? The aging, it's like dog years, isn't it? It's a bit different. And you mentioned right at the beginning as well, when we first connected today, that you've just started bringing on some new hires and stuff. So yeah, just tell me a bit about what is the plans, what are the plans, the vision, etc. What have you got in store?
Well, I think what we're looking at and is to be expanding our investment management team, and that's our new hire. That's literally, well, actually, we're beefing up our operations as well. But we are expanding, and inevitably, as we get bigger, as our assets under management increases, as our number of companies increases, you really see back in the early days, Nick and I had 4 companies to manage. Now it's more like 55, 60. So it's different demands, and we need to, broaden out the scope. And I think also we're looking to establish a new fund that's not a tax efficient fund, but a more conventional fund that looks at sort of that, for lack of a better word, Series A financing. I know this jargon, Series A used to mean something very different 10 years ago than it does today, and probably will 5 years from now. But
how so? Really, what do you mean by that?
Well, it used to be for if some early VCs I know, Series A was like £1 million at a 6 million valuation. That's not what's considered Series A today. So it does change, but it's all jargon at the end of the day, right? I mean, it's
yeah.
I think one of the things that we say to investors is when you look at an investment manager's approach, if you see someone who just invests £2 million in 10 companies, that should be a red flag to you, because all these companies have different needs. And I guess our next stage of growth is to facilitate what we referred to in part 1 as the lifecycle approach, where we get involved at an early stage and grow with the company. And we also alluded to the fact that you don't want to, as a company, be going out and be finding, constantly raising money. You want to get on with the business, and then the money should take care of itself. But it's good to have a trusted partner there alongside. And we just want to enhance that relationship, because our companies are getting much more mature now. And, maybe some of them are exiting. We're a company that should have exited a month ago, but it looks like it's going to happen this week. We're selling to a European company. That's a very exciting deal. So possibly by the time this podcast come out, that'll be on our website. But yeah, there's not all companies want to exit at a given time. And we want to be able to grow there and maybe take them to the next stage if that's appropriate.
And how many exits have you guys had up to this point?
Michael, this will be number 7, I think.
Yeah, I mean, if you count all of them, I think 6 or 7. That's including like
6 maybe
ones, right?
Right.
Some,
okay.
Below par exits. I think people are. I literally did a podcast the other day with someone else, and the topic was failure. And it's another thing that I actually quite like getting on my soapbox about, to be honest. So I'll try not to. But I think actually there's not enough transparency around that. People talk about exits, and there's sort of the assumption is what you're talking about is some massive cash payout because a company has been purchased in its entirety. The reality is that exits come in all different shapes and sizes and flavors, and actually very, very few of them are full cash for the whole business. A lot of it's cash and shares in the acquiring entity. It tends to be much messier. Again, maybe it's sort of picking up on something that Kealan mentioned in the first episode, that having that M&A experience and knowledge under their belts is a huge boon, because I think that's a very oversimplistic view. And the point I made to start this off was, failures are exits too. They're just not they're not the ones you want. So I think actually that's to go back to your first question here, that in terms of what the next few years looks like for Symvan, I think one of the things that's really important is actually starting to, because we've had a few setbacks, partly because things like COVID and the bear market, but M&A activity was down to almost nothing for a couple of years. But I think it's like Kealan said in the first episode, at the end of the day, that's the name of the game here. It's generating the returns and selling those companies and finding some liquidity for investors. That's what we're ultimately going to be judged on. And I think the focus is really going to be on moving into hopefully a cadence of that being repeatable in the portfolio. We've built up maturity in the companies that we've got there. Some of them we've been funding for quite a while now. As Kealan said, they're really starting to kick on. And because of that life cycle approach that Kealan's mentioned, I think where we're at now is that we've proven that sort of model out, and that flywheel has started. So hopefully it should be, it won't, not with the same level of predictability, but a bit of a conveyor belt, that those earlier stage companies are going to start coming through. And if we can pass them on into that larger scale fund and start getting these exits and just create that virtuous cycle, I think that's where we're at now. I think we've proved and sort of validated a lot of the fundamentals behind our approach. On the topic of failures, we've got very, very few failures in the portfolio, which is, for me, that's one of the really, really big parts of what it is that we're doing. It's to try and limit those failures, provide that support, et cetera, because really those big wins that, again, everyone gets very sort of tunnel vision about, they're not events that you can really form a strategy around, because they're very, very low probability.
Right.
In our opinion, it makes much more sense to try and focus on nurturing as many of them through to viability, and then seeing what you can do from there. And I think we've done that really well. We've only had about, across all the funds in over 10 years of operating, we've only had 20% of our companies fail, and that's by the number of companies. If you do it by, if you take a sort of a losses, an actual sort of amount of money that's gone down the drain, as it were, by comparison to what we've invested, it's below 8%. And I think, that, like I say, feels like a good platform for us to build on going forwards. And now it's really about allowing those that have survived that process and have benefited from that support to now hit that point of crystallization in a, like I say, hopefully a more repeatable.
Hi, a friendly reminder to share this episode with your network, like and subscribe. And if you are feeling really supportive, please consider reviewing the show on the podcast platform of your choice. It all really helps support what we do. Thank you. Now back to the show.
Cycle.
It's interesting. Because
in part one, I mentioned that when we first came into the EIS and VCT market, people were focusing on asset-backed plays and not what we would see as real venture capital. And our 285 per £1 invested in an average life of 7 years, that was an outlier in the market. We never encountered anyone. I think the most aggressive we saw aside from that was 160 per £1 invested. So it's a very different market than it's gone back to its roots as venture capital rather than just tax relief for rich guys. Although it still is tax relief for rich guys, hopefully there's a focus on performance as well. But in the model, where does 285 come from? Well, obviously a little bit finger in the air like any forecast, or these early stage forecasts. If you're forecasting, I don't know, revenues for British gas, that's a much more stable proposition. But that model assumes a 50% failure rate. So as Michael says, 20%. That's SCIS and EIS. It's higher in SCIS as you'd expect, because they're sort of typically pre-revenue or very early revenue. But the EIS failure rate is less than 10%. But I think that is a direct result of our philosophy of being hands-on. There are a lot who aren't hands-on, and it's a little bit unrealistic. And that's why I mentioned the due diligence of seeing people just give 2 million. We mentioned earlier about 5 million. you're cutting a check for 5 million. There's too many companies that are early stage that waste that money. It's not a really efficient use of capital. And if you're looking to generate decent returns for investors, you have to really be thinking about the efficient use of capital.
Yeah. But I mean, to your point about your hands-on approach, I guess this is what I was going to ask you about. I guess the next logical question is, how do you scale while maintaining that level of personability and hands-on? Because like we were just saying as well at the end of part one about how even the implementation of AI to something like the community aspect of it, and the fact that you are hands-on and you have this one-on-one time, and that's something you're very proud of. How do you still manage to have you thought about how you manage to maintain that while also still scaling? Because I mean, this is essentially, you're talking about exactly the same challenges that any other business has, right? Including your portfolio companies, where very early on, the deals that they might make with their first customers feel very well looked after. They feel like they get excellent customer service and support. They have a dedicated account manager. They might even be speaking directly to the CEO. And then as things scale, things get more corporate, right? It's quote unquote corporate. And as that happens, things get colder, and they don't hear from them as much. Have you thought about contingencies to combat that as things grow?
Yeah, I mean, I think that the simple answer is that there's only a limit to how far we want to scale.
Right. Okay.
Our plan is never to be hundreds of people big as an organization and investing in hundreds of companies and trying to expand the same philosophy across that many companies.
Quantity over quality.
Exactly. I think for us, as Kealan said,
did I say it the right way around? Quality over quantity.
That's what we want, rather than exactly. I think as Kealan said, we want to add to our investment management team so that we can continue to provide that good support while also increasing the amount of deals that we do. But I think I've said it before, we're historically, we're doing maybe 5 new SEIS investments a year. I don't think we really ever want that to be more than 10 tops. Maybe this year we'll look to do 6 or 7, but I think you're right. It is almost impossible, I think, to really play out the strategy that we've employed for the last more than a decade at a massive scale. So I think for us, it's not about that's not the end game. We want to continue doing what we're doing and doing it well. It's about enhancing how we do it, and that's why, as Kealan said, really the next step is not, well, let's make the fund 3 times as big. It's let's add the next fund in that state, the next stage of funding for them. And then that can be almost siloed separately. At that point, you've established relationships possibly over 6-7 years. So you've done the groundwork, and passing them on to your later stage fund is a lot easier without diluting the messaging or the philosophy. Because I don't think you could replicate it at massive scale. I think you're absolutely right. So for us, it's not about doing that. And I think a big part of that comes from where the incentivization lies. In the first part, Kealan talked about being performance-led rather than marketing-led. Again, without wanting to jump to conclusions about other funds, but there are plenty out there that I think, if you look at the fee structure, you have to ask where the incentivization is. If a fund is charging 3 or even 5 years annual management fees up front, what incentive do they have to make sure that you go the distance? They've made their money off you as a founder from day one, as soon as they've written you that check. So if you fail at any point in the next 3 to 5 years, it's literally no skin off their nose. If you're not going to be one of those unicorns or whatever that returns the fund, what do they care? It goes back to the point we made before about aligning interests. Our model is based on the bulk of our remuneration coming from those successful exits, coming from performance on successful exits. So even in the fee structure, there is not a massive pull for us to go, well, how big can we get our AUM so that we're constantly charging 2% on that, and that's where we make our money. No, the whole. It's not just the investment philosophy, but also the remuneration structure, the fee structure that we put in place is to kind of keep us on that path towards being hyper-focused on trying to get as many of those companies to a position where they are sellable and ready for that as possible.
But it's also, I suppose, an element of this, and correct me if I'm wrong, but I would imagine an element of this is also reputational too, because if at the end of the day, you need to have a reputation that you're easy to work with, which, by the way, I think is one of the most underrated things in any business to just be easy to work with. But also just not predatory, right? And unfortunately, there are a lot of funds that have that reputation, and they're not going to get the best deals stand on their table, right? You're going to be left with the scraps. And so you have to think long term. Word spreads, founders talk. I'm in like 20 different groups of founders, and there's always a fund that's being put through the ringer on there. Someone will say, just had a conversation with this angel investor or with this SEIS fund or whatever. Like, stay clear from them. Like, here's the term sheet. Like, look at like what they're doing. So I suppose you've got to bear that in mind too. Out of all this,
you're right. Reputations like that take a long time to build up. I mean, Kealan alluded to it earlier. In the early days, even when I first joined, a couple of years after you'd started, Kealan, it was no one had heard of us. Why would we give you our money? Why would we come to you for funding when there are established names? It's only sort of in the last couple of years that we've really started to get that recognition more broadly in the market for what we do.
But it's so easy to destroy a reputation.
Exactly.
Like, it can happen in an instant.
I think the problem with it is that because of the nature of VC, to some degree, there is quite a long lag on some of the feedback here. I think it's probably more relevant to investors than it is to founders. But, as an investor, if I've put my money in a fund, not knowing that maybe I don't think there's many people out there in the industry like this who are unscrupulous like that. But I'm sure there are at least a handful. If they invest your money into any old garbage and then let it do whatever, and are sort of getting fat off the fees, and you're seeing company after company fail, it's going to be 5 years maybe before you can really legitimately knock on their door and say, hang on a minute, what's going on here? And even then, they're likely to say, well, look, here's a power law distribution curve. That's how it works. You've just got to be patient. And what we're looking for is that one that superstar that generates the fund. And so there's a lot of wiggle room basically for people to kind of fall back on some of these sort of statistical
and just keep stringing people along.
Exactly. It's by the time that anyone's realized, well, actually it was a complete house of cards to start with. 7 years have passed and it's kind of too late. And that's a good point. But it's true. It's a valid point. I was only considering the reputation as it pertains to founders, but you absolutely have a reputation as well as an obligation to the investors too, right? So it makes sense.
It's interesting, Greg. It's interesting just to build on that point. One of the things that we really strongly encourage companies, like say it's a new company in our portfolio and we're just at term sheet stage. We strongly encourage them to talk to some of our other portfolio companies,
right?
And just see what the working relationship is, because we can't stress enough that you're entering into a relationship. It's not a one-off transaction, and hopefully it's a very supportive relationship. And we're quite understanding if people don't hit their KPIs if it's for the right reason, if that makes sense, because life is very uncertain for startups, and sometimes you think something's a good idea and you might have to pivot or whatever, and we can deal with that, and then we can get maybe more money than we were planning to originally, or what have you, and of course there is a point where you have to pull the plug, and that hence the failures, which mercifully are fairly low with us, but some funds it's very high. Well, one of our competitors, I saw a portfolio from one of our investors, and they had 80% failure rate.
Wow.
And it's that might be an extreme example, but then they didn't really have enough diversification either. They're only in 5 companies. With us, you get sort of circa 10 companies if you're an investor. But no, it's very important. And during we spoke in part 1 about the bubble, because financial markets of all sorts, whatever asset class that may be, always are characterized by bubbles at some point. And they happen every few years, and then invariably the bubble bursts. And so when we were passing on a lot of deals a few years ago, and other competitors were paying 4 to 5 times what we would pay, or sometimes twice, but considerably more. Well, they're not going to make money for investors, so there's a reputation risk there, and probably what I think is happening, why there's been so many failures in startup land recently, is those companies that raise a too high valuation, where the valuation gets ahead of where it should be. What happens when market conditions turn? Well, a lot of them, you find out your VC, depending on who that is, they may be sort of the ones who say, no, here there's 20% of my portfolio I value, you're not in that 20%. And if that's the case, you're out of luck. And a down round is never a good look. A lot of those companies end up failing. People don't want to touch them. And but I must stress, actually, it's very hard going through bubbles.
If you are enjoying this episode and want to support the show, please like, subscribe with notifications turned on, and let us know your thoughts and opinions in the comments below. This lets YouTube know we are doing something right. Back to the show.
Because we actually have one point where we're going to give back our SEIS money to investors, because the valuations, we don't want to consciously lose money for investors. But it's very hard to convince particularly younger founders that they shouldn't go and accept 3 times the valuation you're prepared to, and to talk about that relationship. But I guess that's a kind of a product of experience. And having seen these market conditions and having worked, a lot of these people, it's their first time working with a VC. So, but it really brings back the whole idea of a relationship. It's not just about valuation or about, this or that. It really is an ongoing relationship and a sort of mutually supportive relationship.
Well, I mean, you've convinced me, so I'm going to have to put an application in. But as we're running out of time, I've got 1,000,001 questions I still want to ask, and different threads I want to put on and stuff. But I'm going to have to I've decided on one, which is such a shame. I've got so many more. Maybe another time we'll do it. But which is just this to end on. I'm just really curious, for those that are interested in working in VC, what would you say are some of the sort of things that they should be, skill sets maybe they should be looking to develop, or routes that they should be looking to take? And conversely, what is it the kind of attributes that you would consider to be kind of really key and valuable in order to work in VC?
Yeah, that's a really good question.
Say the best to last.
And it makes me feel a little old that I don't sort of have an obvious answer to my fingertips, because it's been a while since I got into it. But I actually think it's changed since I started. It's enough time has passed that I can say that and it not be completely meaningless. Over the last decade, I think it has changed a lot. I think it took me a little while to not feel a bit out of place and maybe a bit of imposter syndrome. Because I think at the time that I started, I think overwhelmingly, it was an industry where most people had done economics or management type degrees or finance degrees, or they'd done an MBA, and a lot of them from the same place. And you get quite homogenous looking investment management teams at some of the sort of more established funds. I think that's much less the case now than it used to be. And to pick up what we were saying in part 1, I think that's an unalloyed good. I think diversity of thought, as you said, is really, really important. In our team, like Kealan said before, we've got finance backgrounds, we've got a legal background in myself. One of our team members before had done a master's in AI and machine learning. Another guy before that, he had his degree was in chemical engineering, and he'd worked in the energy sector for a little bit before coming to VC. And I think having that variety of backgrounds and opinions and perspectives is super important, because unless you're wanting to work in a very specific area, like if what you want to do is life sciences and biotech or something like that, then obviously you need quite specific technical knowledge to really be able to appraise companies like that and support them if that's part of the investment thesis. But other than that, as we said before, especially at the early stage, it's just messy, really. Yes, industry knowledge and sector knowledge and business model and go-to-market experience, and having seen those patterns before, is hugely helpful, and it's a massive part of what underpins the kind of value we think we bring to our companies, and why we invest in the areas that we do. But I think for someone who wants to break into it, I don't think it's necessary to have a very very kind of pigeonholed skill set. I think as long as and it depends on what part of the industry you want to get into. If you want to get into the investment management side and deal sourcing and origination and due diligence and actually working directly with the companies, really, I think you just need, at the most fundamental level, a very open mind, a willingness to kind of learn and pick up things quickly. Because unless you're really sector specific, when you're assessing a deck, you need to very quickly gin up on whatever it is that the market they're operating is. So you've got to be able to do that and absorb that quickly and analyze it quickly. And like I say, remain open-minded about it. So kind of a willingness and an ability to learn quickly, I think is just sort of the baseline here. Everything else is sort of, not everything else, but a lot of it, I think, after that is experience.
If I'm to add to that, there are two general qualities I would say that a budding VC investor needs is creative problem solving and a tolerance for madness.
Tolerance for madness. Yeah, I think I have that because my wife's nuts.
Well, one of the things that I used to say, because invariably there's all the companies it's usually they're very related, because the creative problem solving is there's always new and interesting challenges that are thrown out to companies, and it's often panic, and you've got to be able to be sort of offering some sage advice and think through the problems. But one of the things I used to say to my young investment managers was you're still young enough to consider a career change. Because invariably there's craziness happening with the portfolio companies, and half the time you're rubbing your head, but it's definitely a very different life than a sort of more conventional financial services or even in a conventional technology company. It's quite a different world.
Well, I've always said I think there are two different types of people in this world. There are people who thrive in chaotic, mad environments and uncertainty and messiness, and those that fall apart and just don't know what to do. I think this entire sort of industry that we're in, whether it's VC specifically or in startups, whatever, I mean, you need to be the former, otherwise you'll get chewed up and spat out. But that's interesting. I think that's really useful for because I know a lot of people that listen and watch this show are interested in the prospect of maybe working in VC. We've had VCs on before. We've had people tell me as much when they've given advice on that and different routes to get there and stuff. And I'm so glad to hear increasingly and yourselves included that you don't need to be in the old boys club to do that anymore. It's a far more open sort of industry than it was, and I think that's really great. That's really great to hear, because it needs to have, I think. Like you said, like we talked about, this diversity of thought coming into it, of all different kinds of experiences. I mean, especially ex-founders and ex-operators and stuff like that, ex-consultants can bring a wealth of knowledge. Yeah, great. Well, wonderful. Look, I'll let you guys go. Apologies for making the error of going at a half an hour over in part one. To both of you, and also to the audience watching, if you were expecting the standard format for this one. This is the penultimate episode, by the way. The final episode will be next week. It's actually with the founding COO of Headspace. So that's going to be an interesting one. Thank you both so much. I will include, of course, your LinkedIn profiles in the description, as well as the website to the firm. Is there anyone else you wanted to shout out or point the audience to? Anything at all?
Well, if you're interested, please go to our website, Symvan Capital's website, and whether you're a company or an investor or just generally interested, we've just actually rebranded, so it's a very fancy website now. It's much improved over what it used to be, but I hope there's enough information there to provide anybody with further information if they so desire.
Awesome. Michael,
Greg, I want to say thank you very much.
Oh, my pleasure. It's been wonderful chatting with you both. So my absolute pleasure. Michael, any portcos you want to shout out?
Ooh, I mean, I could not. I'd be absolutely strung up if I only named a couple. I think.
Tell me who your favourites are. Go on.
Yeah, I'm just going to sound like such a saccharine answer, but because we've said it so many times over the course of the podcast, we get pretty attached to some of these companies. Some of these founders I've been working with for 7-8 years now. Some of them through some really difficult times. I count them as people I'm quite close to. And that's sort of the way we try to look at it. So we're not. I'm just going to say, I like such and such because it's doing really well and they're now hitting 5 million ARR. They're all important to us, and so I would, again, it's a bit of a saccharine answer, but I would encourage people to look up our portfolio, because by definition, pretty much all of them, especially if they're ones we follow on into, we really believe in, and some of them are doing some great stuff. So yeah, I would shout out to all of them.
Good answer. Very diplomatic. Wonderful. Well, yeah, thank you again so much to both of you. Been a very interesting conversation. Could have easily carried on. Like I said, run out of time, unfortunately, but had lots of more questions. But yeah, all that's left to say is go and check Michael and Kealan out, as well as all the other information I'll put down below. And thank you again. Have a wonderful evening.
You too, Greg. Thank you very much.
There we go. We did it slightly over. Apologies for that, but we managed it.
No problem.
Thank you for listening and/or watching. Please like and subscribe, or if you are listening via podcasting service and want to show your support, consider rating or leaving a review. It really helps. See you next week.